kind of three paranoias as you come up to present. One is we're running late. Number two, I'm going to keep you from canapes a little bit longer. But number three, I felt like a little bit of a best man sat there thinking, we've had two speakers on Larry's letter, then I had Eileen talking about some of the content. So I was hoping no one steals the content. Luckily, no one did. Let me say one thing. What I've heard today, since I've been here, is a discussion around the need to do more within climate, and the role of investments has been part of that. And it all sounds great. But we are battling a kind of paradigm here, which is a desire to do something, but a philosophy in the financial markets and in the way traditional thought has been driven from Friedman, which is the only social purpose of an organization is to maximize profit. And so as we think about the debate today, there is a maximization of profit issue that we've got to face alongside the climate issue. Now, 2 years ago, we've talked about Larry's letter today, okay? But 2 years ago, Larry wrote a letter which was all about what I would call purpose. And I'll just read you a little statement out of it that just kind of sits with me on a daily basis. To prosper over time, every company must not only deliver financial performance, but also show how it makes a positive contribution to society. Companies must benefit all stakeholders, including shareholders, employees, customers, and the communities in which they operate. And I think that's what the panel we heard was just talking about. So people have not been listening to these statements over the past few years. 2 years ago they started. Today in the FT, 3 articles. 1, CEO Vitality. Call to action, healthy employees, better well-being, better organizational performance, please sign up. Number 2, Greenpeace, new CEO of BP. There is a world out there beyond fossil fuels into renewables. Please listen to us. And then number 3, the big read in the FT, all about the transition to, is it a 1.5, is it a 2, is it even a 3% temperature increase world that we're facing today? And so we just believe that sustainability is a major foundation in the portfolio construction for investors globally. And it is our assertion that climate change is going to drive a profound reassessment of risk and asset values. We're going to see the investments move faster than the climate. And if you think about the debates we're having globally, the number one topic, if I'm in the Middle East, if I'm in Australia, the US, wherever, is all about climate. Which is why Larry's letter is so prescient in today's world. We also think 2019 was a turning point. We had there's 830 major weather events as tracked that achieved an impact beyond a certain level. One of those is fascinating. The largest utility company in the largest state in the largest economy went bankrupt. We had geopolitical trade tensions between the EU and Brazil because of the Amazonian forest fires and deforestation. We had 6 million students doing a sit-in because of climate. Do not tell me the US is not going to be ready for climate change. It's coming. It's there. Everyone thinks they're late. They're catching up. It is an issue. And we entered this decade with the ravaging bushfires in Australia. And so as we sit there and think about those profound consequences of climate change, we know it's coming. And we know it's going to have a material impact on investment. I spoke at an event 5 years ago at the UN, and I talked about the need to modify investment product to cater for the new wave of investors that are coming. They're called the millennials, okay? People said to me at the time, we'll have retired by then, Lomas, it's not a problem, don't worry about it. I'm telling you now, it is coming. 30 trillion of wealth in the US alone is going to transfer from one age cohort to another over the next decades. They have a higher propensity to invest in these type of factors. They're also going to become the new CEOs, CFOs, and CIOs of the future. So we just know this is a topic that is going to continue to develop and one that we want to be ready for. Now,
it is our view, can I get the slides up? Sorry. It is our view that climate risk is investment risk. And I was fascinated to hear some of the debate earlier. We are spending an enormous amount of time, an enormous amount of money to try and understand how climate risk is going to impact portfolios. And I do think this assumption that you have to compromise your principles for returns, I don't think is valid today. I think there is enough data it is building to show that we can actually deliver investment returns even whilst we comply with the principles and requirements that our investors have around sustainability, E, S, and G, whatever you want to call it. We think that is real. So let's just think about it for a moment. What will happen to municipal bond financing if the major seaboards in the US don't cater for flooding? What is going to happen to the 25-year mortgage here in the UK if we have houses that are built in locations where flooding may occur? How are we going to, as an industry, make long-term decisions when those types of issues are definitely going to be with us? And how do we, as we talked earlier, model economic growth in the emerging markets if we see their productivity, as described earlier, decline due to extreme heat and other climate? So for us, we think these are profound. So the question of data, we've developed a tool. It was in Larry's letter. It's called Carbon Beta. Okay? And at the moment, there are 57 carbon pricing initiatives in effect globally. These initiatives cover around 20% of global greenhouse gases. It's actually more than 5 times what was covered 10 years ago. And despite this interest in carbon pricing, we still have a major shortfall countrywide, jurisdiction-wide, in terms of setting prices for emission risk. And most of those emissions, the set price of those emissions are too low to meet the Paris Accord. So what did we do? We wanted to help our portfolio managers. So we looked at what is the return across a range of equity exposures based on a $25 metric ton of tax. The industry today is pricing between 0 and 125. Sweden's pricing it at 125. Okay, so we've just done 25. We're taking a pretty conservative view here about what the impact will be on portfolios. And this is the impact. So if you think about carbon taxes coming, there are winners and losers. Where are you positioned? Within each of these segments, there will be winners and losers. But what we can see is that if we took this global equity portfolio, ran this shock, there is a underperformance in global equity markets. So this is real. The next is, I heard someone talking earlier in one of the breakouts or in the coffee talking about accounting. And this for me is phenomenal. 40 years ago, 80% plus of valuations came from the physical assets of an organization, of a company. And 17% was what's called intangibles. We flipped it on its head. So if you were a private equity investor thinking about physicals, but actually you'd made an investment in a plastic bag manufacturer, and then you watched The Blue Planet and probably had a little bit of a moment, that's an intangible. And we are not keeping pace from an accounting standards basis with these factors as we get to valuations of companies. And current accounting methods today, they're too narrow-sighted and they fail to account for the mounting share of market value that is created in the intangibles. And intangibles are IP, they are brand, they are copyrights, they're goodwill, they are your employee satisfaction surveys that are on Glassdoor, that we can scrape the data. We can read millions of text in seconds and take an assessment of an organization. We can compare the CEO's statement in their analyst presentations with the CFO. Why? The CEO's sometimes a little bit more flowery and a little bit more positive. The CFO is a little bit more circumspect, and there is a story that you can map and build. The text allows you to do that. Inside of here is sustainability. Inside of here are all the things that are bothering your employees. I can tell you at BlackRock, 2.5 weeks ago was probably the proudest day for the firm. And when you actually speak to the employees, probably the proudest day for them individually because of the statement that Larry made in that letter. And I can tell you the feeling that that generates inside the organization is phenomenal. How you measure that, I've got no idea, and we'll talk a little bit about SASB and TCFD later. But there has been a study by Alex Edelman, which shows that the 100 best companies to work for in the US earned outperformance over a 15-year period of over 50% of their peer group that didn't comply with the findings of the top 100. So there is some value for getting this right. So let me talk about data, because I've heard a lot about it. This is a piece of work we did with Rhodium Consulting last year. The title of the paper is called Getting Physical. I try and make a joke about Olivia Newton-John and the song, but I think I show my age rather than anything else, so I tend not to here. But this was looking at utility stocks, municipal bonds, and mortgage-backed securities, so commercial mortgage-backed securities, so commercial real estate. Now, what this is showing is the economic impact in 2060 to 2080 based on climate change. And as you can see, down the eastern seaboard into Florida, along the bottom and up the west coast, significant consequences based on the impact of climate. Some 58% of the US metro areas are going to see GDP losses of up to 1%. But actually, the intra-year volatility is profound. If you look at Florida, Naples, Panama City, and Key West, they're likely to see annual GDP losses of up to 15% or more, mostly driven by coastal storms. So if you're insuring property here, if you've got municipal bond exposure here, if you've got any insurance exposure here, there are challenges. So what did we do? Well, we said, well, let's have a look at the US electrical utility plants. You make a long-term decision. They're geolocatable, so they could be anywhere. We kind of put them where the worst events are. And we look at them from gas, coal, nuclear, and so forth. Now, the issue in the US, as many of you will know, is that the US has an aging infrastructure. A lot of these stations, power stations, are older design standards. I live there. Power outages, they happen frequently in summer and in winter. That's just because of the power demand that comes off the grid. And there are, as we saw with PG&E, potential significant losses for investors if you're owning the wrong type of investment. Now, what we did was think about hurricanes, which are about 15% of the major impact that we see within the US as we looked at climate. And what we then found was, so let me take a step back, I'll come on to hurricanes. There are 4,500 power plants that are publicly owned in the US, and we aggregated them into a hypothetical portfolio of 269 traded utilities. And we think that if you are owning these power plants in these locations, this is an issue. So we think there is data supporting the challenge that is facing the industry today. And this is just one little example. Let me try and bring it to life with a shock on hurricanes. So we actually looked at the impact of hurricanes and to see if it's actually priced into the market. What we have here on the left-hand side is the relative return. So the relative return here of a S&P 500 utilities index relative. So this is the hypothetical utility portfolio that I showed you, which was built from all this data. So this is the return relative to an S&P utility. So we took those 269, we built an index, and we compared it to the utility sector in the US, which is a different cohort. On the left, you can see the return, and on the right, you can see the volatility. So days to landfall, you can see there starts to become some movement. And then we started to look at actually what happens post. And what you can see here is that on the left-hand side on relative return, there is a deterioration in asset performance, and on the right-hand side, there is a significant deterioration in the volatility of the portfolio. So what we're doing is taking examples of this, and this is one tiny example of data. So to the point earlier, we are using data, we are creating data, okay? And we are trying to help our portfolio teams and our clients understand the impact and consequence of these change. And for us, we think this is all mispriced in the market. We think there's an enormous opportunity for investors to take advantage of. But what we worry about is we are actually not on a path to 1 degree or 2 degrees, but we're actually on a path to 3 degrees by 2100. And so actually these consequences are just the beginning of the issue that we've got to address. And so from our sense, there's a number of things we've got to do. So what have we done? You've seen Larry's letter. We are, number one, accelerating our ESG integration efforts. Eileen talked a little bit about that. So thinking about what we invest in, what we don't invest in, where we have the power to make those decisions. Number two, increasing the amount of choice to our customers. This is an $11.5 trillion industry already. We have about 600 billion. 90 of it is actually in what we call sustainable products. We want to get that to $1 trillion. We think there's an enormous demand and opportunity here. And on the right-hand side, we are enhancing our stewardship processes. But I just want to say one thing on taxonomy. There are 80 taxonomies that exist, which, as Eileen mentioned, are causing enormous confusion. We need a common language to support the clear articulation of where an investment sits on the spectrum of investable assets. It's too complicated today. Scoring methodologies differ. Investors need to gain greater transparency. And today, existing ESG data has a number of material drawbacks. They include quality of data. They include overage. They include consistency and frequency, and a lot of it is self-reported. And so actually it's very hard to get to the bottom of what this data is trying to kind of tell us. So what we've done is look at those data deficiencies. We've looked at the work we do in the markets. We've started to pull data from multiple sources into Aladdin to create a customized database that combines all these together. What we've also done is the following, which I think is probably the first time a manager's ever done this. So number one, we are now asking all companies we invest in to ensure that they are disclosing under the SASB standard. So we know nothing's perfect, but it's the best we can see at the moment. So to try and drive a more standardized approach to data and data collection and insight, we're going to be using SASB. For evaluating and reporting climate-related risks and governance issues, we're going to be asking companies to report under TCFD. And so, we're not perfect. We're not where we need to be. You can see where we are on SASB on the website. We've committed to get our TCFD done by the end of this year. But as we look at what our expectations are of all our investee companies that we talk to, what are we going to do? We're going to be more transparent around our stewardship, which is on the right-hand side. I will say we've done a really bad job in telling you all what we've been doing. and all you will see is the number of votes we cast, and it's 150, and it sounds terrible because there's thousands of securities in the marketplace. We're going to stop that. Because actually, the moment you get to vote, where you have to try and influence, you're too late. You want to be engaging much earlier in the process. Last year, we voted against or withheld votes from 4,800 directors at over 2,700 different companies. So from now on, we're going to be moving to quarterly disclosure rather than annual. For any high-profile votes, we're going to give an explanation. And where we feel companies and boards are not producing effective sustainability disclosures or implementing frameworks for managing these issues, we're going to hold the board members accountable. And finally, given the groundwork we've already laid engaging on disclosure and the growing investment risks surrounding sustainability, we will be increasingly disposed to vote against management and board directors when companies are not making sufficient progress on sustainably related disclosures and business practices and the plans underlying them. So for us, this is a major statement. For us, this is a major piece of work. We have a lot of work to do ourselves to get ready for this. So do the companies we invest in. But our commitment is pure, that we want to move the investment industry away from the Friedman concept and into a world where you can invest sustainably without compromising the principles and the returns that investors want. And with that, I'll thank you very much.